Good evening, everyone, and welcome to Admiral Markets webinar. Today is 23rd of September. My name is Nenad, and we will talk about leverage, over leverage, and position size calculation. So, guys, if you're still concerned that you are not sure about your entry position and size, I will show you how to calculate proper position size. I can send you a calculator. It's called money management calculator, and you just need to send me your email after the webinar and I will send you the calculator. So this is very important because ultimately it boils down to risk management. It doesn't necessarily mean that if you are a good trader and have a good trading system that you will make a constant profits in Forex market. Because of that, you need to understand the difference between leverage, pip value, over leverage, and to know how to calculate proper position size. Okay, so before we begin, always read disclaimer first. So online educational materials are developed by Admiral Markets, and to get all corresponding information, you should visit admiralmarketsglobal.com, select your country, and contact an appropriate entity. Also, risk disclosure statement stating all possible risks associated with Forex market. By accepting the risk, you're also proceeding further with me. And final part, Admiral Markets takes no responsibility for information accuracy. This is my opinion, and Forex is risky business. So this is just for informational and educational purposes only. Okay, and always good to remember that Admiral Market Supreme Edition is available for you to download by Traders Room, and also you need to know that Admiral Markets have been officially voted as best MT4 broker, so your deposit is secure. Okay, today's agenda: leverage, over leverage, pip value, position size. Okay, what do we do about this, guys? Okay, what do we do about this? And yes, the first comment is Eater Wachli. I would like to have the calculator. Yes, but please don't send me your email. Send me an email. Okay, you need to send me an email request. Okay, so my email is tarantulafx@gmail.com. Okay, so send a request to me and I will send you the indicator. So these are the topics which we will cover today. So primary money management is about three things. Okay, three things. Okay, primary thing is not to lose a capital and stay on the flow for many years. Okay, gradually multiply your equity figures. Okay, that's also very important. And third is to earn profits. Okay. Now, problem with many people is that they set the third task for the first place. Success always comes down to a proper risk management. Okay, so do not change the third task for the first. Okay, because your aim is not to lose a capital, and you should stay on the flow for many years. The only thing that you can achieve that is by doing a proper money management and risk management. Without it, your account is in big danger, and I will explain why. So what is leverage basically? Leverage is, simply put, brokers provide you with more money than the balance in your account. Okay, so it works by establishing a rate you can use for every euro or dollar in your account. Okay, that means that the money you put for a trade is the actual money you risk. It's also called margin, or the amount you risk. Okay, so the money you put for a trade is actual money. It's your risk and it's margin. So we use leverage to increase profit potential. Okay, that is why we use leverage, to increase profit potential. For example, for 1 to 100 leverage, we need $1,000, and then we have a contract of $100,000. Of course, for people who deposit $100,000, they do not need any leverage. Okay, leverage is usually used for people who trade below $100,000 of real money. So if you want to trade $100,000, you need to use 100 to 1 to 100 leverage. Okay. For example, you have $100, and in order to trade as if you had 100,000, then you need to use 1 to 100 leverage. Okay. For people who deposit $100,000 euros, let's talk in dollars, you don't they don't have any leverage, so they are trading without any leverage. Okay, so if you make 100 pip of a standard lot, that means that you would make a profit of $1,000. That's because for every dollar in contract we made 1 cent, so it equals to 100,000 times 1 cent is equal to $1,000. Okay, so if we make a loss and the value of contract drops to $99,000, the deal is off. We don't have any money. Why? Because we traders guaranteed with $1,000. So when you made a deposit, of, let's say, $1,000, and it's your guarantee. Okay, it's your guarantee. It's your money. And brokers gave you a leverage, effectively giving you a money 99,000 to trade, and that means that you are trading with 100,000 instead of 1,000. Okay, why? Because in forex trading is very small price difference. Okay, forex trading involves very small price difference, and if you traded, for example, $1,000 without leverage, you wouldn't make anything, guys. It will take years and years to make a profitable trade a profit. Okay, I'm trying to explain this as simple as I can, really. So if anything is not clear to you, you can ask me. So this is very, very simplistic explanation, and that everyone, even novice, very novice traders can understand. So 100 to 1 leverage, we need $1,000. Okay, for example, to trade with $100,000. Okay, because if we traded with only $1,000, we wouldn't make any profit. It will be years and years. Okay, so leverage exists for retail traders just to create a possibility of making bigger profit. It's necessary because forex trading involves very small price difference or differential. So it would take a long time to make a meaningful profit or investment. So using leverage, you get a return of your investment much faster. Okay, but that means that leverage should be used wisely. Okay, because it's double-edged sword. Okay, leverage ratio is based on the notional value of the contract, usually domestic currency. Okay, so that is usually domestic currency. So that is leverage ratio. For example, I recommend no more than 5 to 1 leverage for your trade. For example, if the account balance is $5,000, don't trade with more than 2,500 per position. That equals to 0.25 lots. So that is maximum you should trade if you have $5,000 account. Now, of course, we will talk about risk, but this is a general advice, guys. This is general advice. So if your account balance is $5,000, you should trade with no more than 0.25. Okay, proper risk is 0.5% to 1% per trade. For example, if the stop is 20 pips, we use following formula. Okay, stop loss times leverage, that sum is divided by 100%. In this case, it's 20, for example, times 5 and divided by 100, and that means 1% of a risk. Okay, so that is how I really advise you to do, because overall your account will be grateful to you, and you will be grateful for me as I'm teaching you how to save your account from big drawdown, which is almost impossible to recover. Okay, The thing is that you should always remember, guys, stop loss is dynamic, risk is fixed. This is what you need to remember always and forever. Okay, it doesn't matter if your stop is 30 or 100 pips. Stop loss is dynamic. You change stop loss according to the market. You cannot always trade with fixed stop loss, right? So you need to adapt your stop loss. But risk is fixed. That is why you need to calculate your stop loss prior to opening a position, okay? You can see from my account example that using proper risk size and management can give you an overall great balance on your account and good equity curve. This account is 3 years old, so this account is not made 3 months ago, so it's 3 years old, and the money from this account is transferred for Camarilla MACD and HARP. Okay, so both trading methods will be done on that account. So basically, guys, when you apply proper risk management, you ultimately will be in profit. Okay. And now, how trading firms do it? So, as you probably heard, there are a lot of trading firms which give you the possibility to, for example, to manage your account. And now we are coming to the part just to differentiate between basically trading one's account and trading multiple accounts. Because if you are a trader, professional trader, a lot of people ask me, if I'm so successful, why don't I trade other people's accounts? The answer to the question is very simple. It just doesn't go like that. First of all, dealing with the people is extremely stressful, and I did that back in past 4 years ago, and basically I will always remember the case when a client asked for me to make him 10% per month. I told him I cannot make you 10% per month. Usually my return is like 2% on average. That is because I use conservative stop loss. I am a cautious professional trader. I cannot risk more than you can afford. Because if you want to make 100%, you need to be ready to risk your account. So it's basically for 20 or 50% of risk, you need of gain, you need to risk 20 or 50%. If you want to make 80%, you need to risk 80%. That's nonsense. Okay. That is one of the reasons. Then I started to trade the account. I made him 4% that month, and he closed the account before my eyes. I swore that day that I will never ever do that again. I don't care. I don't really care about managing other people's accounts. That is one of the reasons. Humans mean people generally, tend to be very greedy. They are told that there are people who can make them 20, 30% per month. Okay, it's okay, but look at the equity curve. I'm sure that after some time they will have no account. And if someone tells you that it's normal in Forex market to make 20%, 30% per month, then guys, you should really consider that that guy does not know anything about Forex trading. And believe me, I will always repeat it. I see message there is no sound. Can you confirm that there is sound, guys? Just type OK if there is a sound. If no sound, I don't know why. Sound gone. Can you confirm that we have a sound now? There shouldn't be any sound problems. Okay. Okay, I'll check the sound. Okay. Okay, guys, do you hear me now? Because everything is okay here. Okay, great. I don't know why there wasn't a sound. So where did what was the last thing that you heard me talking? What was the last thing that you heard me talking? Just write it down so I can continue. Yes, people are greedy. Exactly, Darshan. And exactly, you risk 50%, you lose 50%. It's always like that. So if you want to make 50%, you need to be ready to risk 50%. Okay. 30%, guys, per month is not realistic. You can make it. I know it's possible. But if you want to be profitable in long run, that is impossible. So you need to be profitable for years to come, not 1, 2, or 3 months. Okay, that is why I'm always against fast profits. Now, we need to differentiate between gambling and trading. I always say, if you want to gamble, it's better to gamble in Forex market because we know where we trade. Admiral markets is really uh, not. It's not my opinion. My opinion has been like that for last couple of years, last 5 years. But generally, it's been voted for best MT4 broker. What that means? It won't cross you. It's regulated. Is any casino regulated? Casino is regulated by regulations which are implied by the state where casino is located. So it only abides of the rules which state imposes. Okay, it doesn't have. It has their internal structure, but believe me, uh, there is always a fixed win to loss ratio in casino. And Caroline, some brokers can spike you out. Admiral markets will never spike you out because please register for a webinar. Me and Chris will have mutual webinar about ECN and DD and STP brokers. So I will explain definitely how brokers make money and why honest brokers will not hunt stop loss. I have never had any of that case with Admiral Markets, and it's fully regulated. You need to know FCA license, uh, which has been constituted by UK and which has been issued by UK is the hardest license to get. So that is definitely one of the biggest advantages. Okay. Uh, and well, when ECN account is always the best. Of course, there are other options, but ECN has a okay. We will talk about it. It's not now it's not in today's agenda. Spike you out means, for example, if your stop loss is here and price goes up and it hits your stop loss virtually. So when you compare it to real price movement, there was no candle. Admiral markets never do that. And other brokers do that. I cannot name the broker, but I personally know that other brokers did it, but those were unregulated brokers. So let's back to our subject. So because we people, human beings in general, are greedy. I was explaining my case with trading 4 years ago. Uh, uh, well, an investor came to me and asked me to trade his account. He gave me money. He gave me a password to trade. And I told him I cannot make 10%. He asked for 10% per month. I told him that my average gain is usually 2%. With all wins, all losses, on average, it's like 2%. And okay, he told me, okay, I made him 4% that month, and he closed the account before my eyes. I never saw the person. I don't know anything. So I swore that day I will not trade other people's accounts. Okay, that is one of the reasons. I really don't want to get involved in that. It's very, very it's you can never ever bring back your nerves which you lost by dealing with people. Okay, so that is one of the reasons. Yes, probably someone promised him 10% and lost it all. It's normal, guys. As long as you cross 5% of risk threshold, you're in danger zone. I always say you can gamble in casino, but if you want to be overall profitable, try to make something out of $100. If you can make money with small account with low leverage, then you can always make money. If you cannot make money with low leverage, then high leverage will kill your account. Also, the second reason, if you want to trade someone else's money, you need to have a proprietary trading firm. I worked for proprietary trading firm in 2009, and basically a proprietary trading firm has analysts which search for trades ideas, securities, market research, analysis of every pair, scanning for the pairs. Then it has a trader who is making a decision to open or close orders. And also it has a risk manager who controls risks, daily loss limits, etc. So I know that because I worked in a trading firm. Okay. And because of that, guys, trading firms employ people who are specialized in their field. There is one or two or three analysts, there are a couple of traders, and one or two risk managers, depending on the portfolio, whatever. But the thing is, if a single guy does this, what is the chance of an overall success? Well, it's stressful. You can be successful, but guys, trading with big money, of course, involves some degree of respect to that people's money. So because of that, you need to diversify risk across three, let's call it three separate sectors: analyst, trader, risk manager. Let alone one person do it. Carolyn is saying in Romania there was a broker man who promised that and lost all the money of well-known people, musicians, actors, fashion designers. You see, Carolyn, that guy is a con man. It's a con. So it's a perfect heist. It's theft. Call it whatever you wish, but that is definitely for a jail. Okay, and yes, 2% per month equals 26 per year. I always repeat, guys, how much bank will give you over a year period? Probably 1 or 2%. Well, guys, if you make 20%, you are always better than bank. So it's your own money, and when you deposit money in your bank uses your money. So basically it's you, right? I said it yesterday, always improvement begins with I. So over leverage, guys, do not forget now, this is important. Your margin is your investment. Remember it. Your margin is your investment. Okay? That means if you invested 5,000, it's your margin, right? It's your investment. Anything above it, leverage, is basically borrowed money. You need to detach your emotions from yourself. Always, guys. Try to detach your emotions. Because if emotions get involved, you know what can happen. Okay, what can happen? That yes, venture capital put on hazard. Ilya is saying, indeed, your capital is put on hazard. Okay, so basically try to split from your emotions. Try to visualize that your emotions are a separate being. Okay, best trader is always one who can detach himself from his emotions during his trading activity. Okay, if you are too excited about trading, it can be disastrous. During trading itself, the heart should beat softly and the brain should be in charge. In a high risk environment, only a slight mistake can wipe out traders' capital. Okay? Mistakes will inevitably happen during trading, and neither man nor machine is capable of predicting every movement of the market. So to ensure that the mistakes basically do not eliminate your capital, your self-esteem, and detach you from your family, just learn from your errors. Do not over leverage. Do not over leverage. Okay? High leverage works against speculator, against trader. It will make your heart beat faster. Okay? The thing is, small losses are not dangerous. No one will jump in his seat over the loss of a couple of dollars, okay? Because you can then learn through your mistakes. But if potential losses increase, a beginner trader or advanced trader who still don't know about his own psychology, he will not have time to focus on the lessons from his defeats, from his losses, and instead will agonize over his bad decisions. So focus on the lessons from your mistakes. Do not agonize. Okay? Because it will begin with spiral of fear, then spiral of doom, and it eventually can ruin your livelihood. Okay? Okay? So this is a typo. So please accept this as a big truth. Even the firms which went in bankruptcy in 2008, such as Bear Stearns, Lehman Brothers, had basically a leverage only up to 35 to 1. Only 35 to 1. Merrill Lynch also. So this is not a big leverage, but it definitely showed that there are no rules. So what is the logic of using big leverage? Just to wipe your account faster. So guys, always try to remember this. Low leverage will save you. And this is a big truth. If you can create good returns with low leverage, expect massive losses with over leverage. This is the truth which you should accept. Okay? And this is most important of all. Okay? If you cannot create good returns with low leverage, massive losses should be expected with over leverage. Okay? Now, for stock traders, stocks can double or triple in price, okay, or fall to zero, but currency never does, okay? So you need to know about it, okay? That is the truth also. We will talk about pip value, don't worry. Ilya is saying low leverage prevents only to open too much positions, but the pip value remains the same. Regardless of the, okay, I refer to this, okay? I refer to this. If you have $5,000 account, are you safer with 5 to 1 leverage? That means 0.25 lots, or you should open one full lot of a trade. What is safer bet? Safer bet is to use, generally speaking, 0.25. Okay? And PIP value is not always the same. Yes, 1% risk per trade is enough. It's definitely the best, always. It's safe. Okay? Okay, if you, for example, if you have, let's say, $10,000, okay, and you open, let's say, 5 lots, okay, now you should calculate how much leverage you use with these 5 lots and how much leverage you would use if you open 0.5. Okay, it's not good because you have the option to increase it, your volume traded. But the thing is, you should keep it within risk limits, because yes, if you open a higher position, you will not have money to cover, for example, for your losses, and you will suffer from a margin call. Even if your account is, let's say, from $25,000 brought down to $8,000, okay, you can suffer from a margin call. Yes, I define leverage not just by using a standard definition of leverage. I define leverage as in this example, okay? As in this example, okay? And you should use this formula to calculate your risk, Ilya, because stop loss times leverage divided by 100% will give you the risk. This is the formula which I use for my trading, okay? And this is far the best thing you can do to yourself, okay? See, stop loss times the leverage divided by 100%, and you will get the risk, okay? But you don't worry, I have a calculator and I can send you. So for all of you who joined later, if you're interested in proper position calculator, money management calculator, just send me an email and I will send that to you, okay? So guys, stocks can double or triple in price or fall to zero, but currency never does, okay? Lower margin requirements is less risky than it would be for stocks, okay? So that is definitely the advantage of Forex market, okay? Now, the thing is, we need to know the term performance bond. The margin in Forex trading and Forex account is often referred to as a performance bond, because it is not just borrowed money, but it is the amount of equity needed to ensure that you can cover your losses. So it is the amount of equity needed to ensure your losses, to cover your losses, okay? In most Forex transactions, nothing is actually being bought or sold. Only the agreement to buy or sell are exchanged. So borrowing is unnecessary. Because of that, no interest is charged for using leverage. Okay? So if you buy $100,000 of currency, you are not depositing 2,000 and borrowing 98 for the purchase. That is $2,000 to cover your losses. So because of that, buying or selling currency is like buying or selling futures rather than stocks. The margin requirement can be met not only with money, but also with profitable open positions. Okay? Total equity in your account is total amount of cash plus open positions profit minus open position losses. This is the formula for total equity, guys. Okay? Now I hope that you understand what I'm saying. Margin is your investment. Margin is performance bond. Okay? Margin requirement can be met not only with money, but also with profitable positions. Total equity in your account is the total amount of cash plus open position profit minus open position losses. For example, margin equals to 1 divided by leverage. 50-to-1 leverage yields a margin percentage of 1 divided by 50 is 0.02, it's 2%. Okay? Pay attention to this. So 50-to-1 leverage yields a margin percentage of 1 to 50, it's 0.02, it's 2%. Leverage equals to 1 divided by margin, 100 margin percentage. So use this if it's easier for you. Okay? So those are the formulas. Okay? Now, what is a pip value? Pip value usually equals to 0.1% of the quote currency. Okay? Pip value. So 10,000 pips equals to 1 unit of currency. Okay? We will talk about it. Pip value is different for Forex pairs. Rule of thumb, by crossing 5% risk threshold, you are in danger zone. Okay? You also can find pip value indicator. I had it somewhere on my PC, but I don't have it anymore. So just try to Google for pip value indicator, and I think that there are some. I'm not sure if Admiral Market Supreme does it. I didn't put it on my charts, but even Admiral Market Supreme edition could show you a pip value. So please check it. I'm not sure. I'm just thinking because I know by heart how many, what is the average volume traded when I open the pair. I don't need a pip value. But for all of you who are interested in pip value, please check Admiral Market Supreme. Maybe there is pip value calculator in it. Now, the examples. The quote currency of a pair is the quoted price. Okay. So the value in pip is in quote currency. So if euro dollar is 0.0001, also dollar euro is 0.0001 euro. Okay. So if the conversion rate for euro dollar is 1.1100, euro pip value is 0.000111. Okay. So that is pip value. Okay. For example, if conversion rate for euro to dollar is 1.35, then euro pip would value 0.000135. Okay, 0.30135. That is pip value. But as I say, you can also find it. Now, remember this. This is, as I say, very important, and I will show you now how this calculator works. So risk is always fixed. Stop loss is not. Okay. Remember this, and this advice will save your account and you from making bad trading decisions. Okay. Money management tool calculates proper volume traded. Okay. And I will show you that on live chart. Okay, here. Money management calculator, for example, you open, it's a script. Okay, so you should put it on scripts folder. And let's say that you use risk percent of 1% and your stop loss is, let's say, 30 pips. For this account, okay, I just press OK. And basically, lot calculator, we say, calculated lot size is 0.51 lot, current spread on pair is 0.2 pips. So for this account size, your calculated lot size is 0.51 lots. Okay, for that account size, okay, it's basically 15,243. Okay, dollars. So let's use it one more example. For example, I want to gamble. Let's say I want to gamble. And I will open management calculator. I will say I want to go with 10% of risk. And my stop loss is, let's say, 30 pips. Look at this, guys. Calculated lot size is 5.08 lot size. Okay? You want to be conservative, very conservative. And you want to risk 0.5% with 100 pip stop loss. Look at this. Calculated lot size is 0.08 lots. Guys, always try to use the logic. If you use 100 pip stop loss, of course you need to lower your volume traded, your lot size. It's always based on your stop loss. Risk is fixed, but lot size is based on your stop loss. Remember that, okay? So this is everything I had for you today. Of course, as I always say, if you're interested to learn more about this, we will cover that, of course, in other sessions, but you can always listen to this webinar again. And actually, in price action trading school, there will be parts of money management, whatever. But at this point, this is pretty much, we covered a lot of aspects of Forex leverage, over leverage, pip value. What is important for us? Darshan is saying, bravo, good material and delivery. Thank you. So if you're interested in this pip, in this money management calculator, just send me an email. I will, of course, send it over to you. Carolyn is saying, we wish you had a webinar how to use MACD. Yes, there will be webinars how to use MACD. I will make webinar especially about MACD, so don't worry about it. I will cover all aspects of MACD indicator. So guys, thank you for listening to me. If you don't have anything well to ask, I can just remind you for future webinars to come. Last session recap, we had 2 wins, 2 losses. Overall, we are positive. Australian dollar loss, pound dollar loss, euro dollar win, dollar yen win. Dollar yen was the trade of the week. Indeed, also New Zealand dollar went heavily in our favor, such as euro yen, but euro GBP, unfortunately, it went through 73.00. Euro is not that strong. It's more like that GBP is very, very weak. Euro dollar, yes, it's in downtrend. Maybe tomorrow I will redo the euro dollar analysis, and there are some good places to sell into. And EG, well, definitely EG, well, first rejections, I need just to show you. First rejection from our POC was very good because I gave you the exact price, something like 70 to 80, and this rejection was good. It rejected for something like 40 pips, but next leg of buying basically kicked through this POC. So that is why I'm always saying, guys, it's always important to take the very first touch of POC. Well, nothing. Euro GBP at this point, it made a rounded bottom. Look at this. This is ascending scallop pattern. So on 4 hour, it doesn't look, it's back in the range. So we won't be touching it. Okay, guys. So this was just a quick look to Euro GBP, but definitely what is always important for every single trade, risk is always fixed, stop loss is not. This can be, if it hits this level, inverted head and shoulders, but 1 hour chart is ascending scallop, definitely. Wow. And it goes to the upside. So let's see, something will happen during next couple of days, during next week. We will see what can we get from this from our analysis. But one thing is for sure, Australian dollar is sell on rallies At this time, also pound dollar is selling on rallies. Even euro dollar can be sold on rallies. Every recap is recorded and uploaded. Okay, guys, so that is everything I had for you today. I wish you very good evening. Relax yourself. Do not overtrade. Use proper risk management. I will send you a calculator, and if you do that, your account will be grateful to you. Thank you, guys, and as always, as I say, trade safe. Cheers.